Hey, what's up guys? John here. The FDIC seized another bank late last night. This happened only hours after Bank of America, Wells Fargo, Chase Bank, US Bank, and a variety of other banks were unable to process ACH deposits, meaning that employers were unable to pay employees.
Banks across the U.S. hit with deposit delays on what is payday for many Americans.
Thousands of people are still waiting for their money tonight. Everyone shared the same message about a deposit delay.
When you're looking at the chain of events that have unfolded in the banking system in America, you have to ask yourself, is this over? No, it's not. In fact, what I believe is going to happen next is hundreds of more Silicon Valley Bank-like events to unfold very soon. I'm going to break it down. I'm going to show you the facts, what's really going on that nobody else is talking about, what you need to prepare for. Please hit the like button. When you hit the like button, YouTube will share this content to educate the people about what's really going on. And if you'd like to fix your credit, we'd love to help you in my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, go to GreatCreditFast.com. Click the link in the description below this video to schedule a free strategy session. Take a look at this. So, Friday, November 3rd, 2023, Iowa Trust and Savings Bank, Emmitsburg, Iowa, assumes all the deposits of Citizens Bank in Sac City, Iowa. Washington, Citizens Bank, Sac City, Iowa, was closed today by the Iowa Division of Banking, which appointed the Federal Deposit Insurance Corporation as receiver. To protect depositors, the FDIC entered into a purchase and assumption agreement with Iowa Trust and Savings Bank, Emmitsburg, Iowa, to assume all the deposits of Citizens Bank. So, they say that during a joint and ongoing examination of the bank, examiners identified significant loan losses that had not been previously identified by the bank. The bank was declared insolvent. The bank had concentration of out-of-territory and out-of-state loans to one industry and incurred heavy losses on some of these loans. Now, what if I were to tell you, it's not just this bank. This is nearly all banks in America right now. All big banks are in very, very big trouble. They say that some of those banks are, they have $7.6 billion set aside for some of these loan losses. But the more we look at this, we have to realize how fast this thing's ramping up. So in March, this is March 12th, right around Silicon Valley, they said in 2022 that banks, end of 2022, were sitting on about $620 billion in losses. Sounds like a lot, right? $620 billion. But when we look at where banks are now, this is March, right? March 23rd, 1.7 trillion. They're sitting on 1.7 trillion as of March. And I think everyone can agree that a lot has happened since March and that these losses have likely grown dramatically since March. And it's probably safe to say that it's well over $2 trillion at this point, probably more. So when you're looking at the chain of events that are happening right now, you have to ask yourself, are we walking into the storm or is the storm behind us? I'm betting that we're walking into the storm. You look at where consumers are today, you look at where inflation is today, you look at where the world is today, it's different than where it was last year. And when we look at, for example, regional banks, they fund most small businesses. They fund most commercial real estate loans. Most loans are done from small banks. For, according to Goldman Sachs, 80% of all bank loans for commercial properties come from regional banks. Many people think that it's the big banks that are issuing all these loans. No. It's the small banks. And these small banks are walking into a storm. They say the concern is that almost $3 trillion of commercial real estate loans sits on U.S. bank balance sheets, a disproportionate amount of which is smaller, less well-capitalized banks, aka regional banks, the credit unions, the small shops. So if they're sitting on 80% of this $3 trillion, maybe they're sitting on $2.5 trillion in losses just there, right? Just in commercial real estate. So when you look at, like, let's say Blackstone, the largest real estate owner in the world, Blackstone, they're selling a building in San Francisco for $82 million. Problem is that they purchased it for $245 million just 5 years ago. So what do people usually do? When they buy a commercial property, they put 30% down and they finance the 70% from a bank or a lending institution. So when you buy a building, let's say for $245 million, and let's say you put $70 million down on this specific deal, and you finance the rest, we call it $150 million, and that building trades for $82 million, that means that bank just took a massive loss, maybe $70 million, $80 million on that one deal, right? Well, when you look at what's happened nationwide, office vacancies are 20% right now, 20%. Here's another one. This is Blackstone. They sell an office building for half of the purchase price. Another one for half of the purchase price. Look at San Francisco here. San Francisco has gotten it a lot worse than many other locations, but not by, San Francisco is not all the way up here and everyone else is down here. San Francisco is up here and a lot of other places are just slightly below. So the losses are trickling through the entire banking system, and a lot of this is going to be set to mature over the coming 6 to 12 to 24 months. So this here, 73% occupied by PayPal till September, right? They purchased this in October for $72 million, which is a 49% discount from the purchase price that they paid in July, right? 49%. Bank is getting crushed on that. This here, another one, Realty sold for $47 million, 47% discount from the purchase price 11 years ago. Another one here, this $40 million, right? For $40 million, 62% less than what Wells Fargo paid in 2005, right? This just sold. Another one, this here, they $61 million and 76% less than it paid in 2020. And it goes on and on and on and on. So you have to ask yourself, how can these banks not be in very big trouble? Because no one else is talking about this. Media might say, oh, there could be little problems here and there. There's massive issues in the U.S. banking system right now, massive. And we're walking into something far greater than the great financial crisis, where a few institutions go down. We're walking into, I believe, a storm. Or as Barry Starlight, who owns 170,000 single-family homes in America, under Starwood Capital Group, said we're walking into a stage 5 hurricane. That's what he said. So 37% occupied, existing lease expiring 18 months. This is August, right? Pay $245 a square foot, 62% discount to the price they paid in 2014. So let's kind of back it up a little bit. If this is just commercial real estate, we have to look at how do banks make money. They make money by lending, taking consumer deposits and lending it out, right? They make money by lending that money out. But deposit at FDIC-insured banks fell almost $100 billion in the quarter ended in June 30th. After a record $472 billion decline in the first quarter amid the banking crisis. Declines were mostly driven by uninsured deposits or those exceeding the FDIC's $250,000 insurable limit. So banks have less money today than ever before, right? They have less money to lend out. They have consumers that can't qualify for a lot of these loans. Consumers are in worse positions than they've been in a very, very, very long time. And a lot of loans that they've been issuing are not performing like they intended. For example, car payment defaults hit 29-year high as borrowing costs surge. Came up 10 days ago, right? 11 days ago. So the car payments are doing really, really bad. The commercial real estate loans are doing very, very poorly. A lot of credit card delinquencies are on subprime borrowers, which is unfortunately most of the market. So you're looking at one loss after the next, but look at this. So higher loan loss provisions demonstrate credit quality concerns at U.S. banks. This came out about a month ago. With the Federal Reserve, the Fed's dramatic cycle of monetary tightening still not over, and the threat of the U.S. entering a recession later this year or in 2024, many people would say we're in a recession now, U.S. banks continue to allocate even greater provisions to address potential loan losses. In so doing, there's a widespread acknowledgement that further credit deterioration is coming. The largest of American banks, nonetheless, reported strong earnings for the second quarter, demonstrating how beneficial higher interest rates have been proven to be in bolstering lending activity and net interest margins. But with the expiration of the raft of government-backed measures that supported vulnerable households and businesses during the pandemic, threatened a seismic wave of loan defaults. Lenders are becoming increasingly concerned about how adversely those rising interest rates are impacting borrowers. The central bank continues to struggle to bring inflation down to its formal target of near 2%. Inflation is not going to 2%. Inflation is only going to continue to rise. If you look at the stats, you look at really what's going on, the facts behind the chain of events that are unfolding with energy prices and a lot of new regulations that are coming in, we're going to see prices continue to rise. But one thing that a lot of banks aren't paying attention to, a lot of consumers are not paying attention to, is that 43.5 million Americans had to start making student loan payments October 1st. And 2 out of 3 Americans, they don't have $400 in the bank for an emergency. How are people going to be able to make these payments? Many of them are not. Many of them are going to default. Out of 43.5 million, I'd say 10 million, 15 million might not be able to pay, maybe more. And so you start to look at this, what's going to happen? Credit scores are going to tank. Credit deterioration is going to continue, and defaults are going to continue across auto loans, credit cards. you're going to start seeing a lot more pain, which is going to be pushed onto the banking system. So you ask me, we're walking into the storm. The storm's not over. We're walking into it. And I think Q1 of next year, Q2 of next year, things are going to get harder and harder and harder. And so I would prepare for a lot more uncertainty in the U.S. economy. What do you think about this? Do you think this is going to be the last bank failure that we're going to see? I don't think so. I don't think so. Drop below. We'll have a conversation about this. If you're interested in fixing your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. As banks tighten up, they're going to be very careful on who they lend money to. So if you have a 500 credit score, 600 credit score, low sevens, get a hold of us. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, or you're just not sure why your score is where it is, book a call below at GreatCreditFast.com, and I'll catch you guys in the next video.